Look, what I say to sort of most founders, and I think this is a pretty good yardstick, is, are you more worried about dilution or keeping the lights on? If you're more worried about, well, I've got bills to pay, payroll, I've got some big working capital movements coming up in the next 6 months' time, I still haven't got my burn rate under control, then debt probably isn't the right answer for you. If you are sitting there going, hold on, I need some capital to grow, everything's working really well, but I don't want to give away 15 to 20% each time I grow, each time I fundraise, then debt is probably a good choice.
So hi everybody, many thanks to be on Aulium. Markus, hi, pleasure to be with you again.
Good to be back as always.
And so today, we have the immense pleasure to be with Hayden Smith. So you are a partner at Mountside Ventures. Mountside Ventures, is a relatively new firm, but it seems that you are already everywhere because, speaking to people, they seem to be knowing you already. You do a lot of things like in the advisory world towards like with startups, but with also like VC firms, and we will dig into this a bit more. So first, Hayden, thank you. Hi, and many thanks to be with us.
It's all hey, Markus, great to be here.
So maybe for the listeners who do not know Mountside Ventures, and I'm sure there won't be a lot, but do you think you could give us maybe like a quick snapshot of what you guys do, how you are involved like in the ecosystem? That would be, I think, a good starting point.
Absolutely. Mountside works across the venture and early stage ecosystem. We're Europe's leading early stage advisory firm. We help founders raise their Series A and Series B on sort of the equity side, and on the debt side, we also help founders raise non-dilutive capital. We also run a number of accelerators and investment readiness programs for founders that are free of charge. And more recently, we ran the emerging VC program, which Sifted kindly referred to as the YC for VC, where we help VCs also raise money from LPs. So as you can see, we're sort of working right across the ecosystem.
So quite interesting to understand that there are some free things out there.
Sorry, I didn't get that.
No, I was saying it's quite interesting and nice to know that there are some free piece of advice out there. Sorry, Markus, I interrupted you.
Absolutely.
So what do you do personally at Mountside Ventures? I was just interested to know how your role is there and what you do on a personal level there.
Absolutely. So I'm the head of debt at Mountside. So I'm specifically focused on helping founders raise non-dilutive capital. So what that means in reality, venture and growth debt, M&A facilities, working capital facilities, asset-backed loans and facilities for CapEx, anything that isn't equity. So all forms of non-dilutive capital. That's. Sorry guys, I'm just having issues with my internet. I'm sure you can cut that last bit out.
So just from the perspective of somebody or founders that are just picking up different instruments in terms of equity and debt funding. So when you say non-dilutive funding, so what are you referring to there as opposed to equity?
Well, I suppose with the equity, in exchange for the percentage of the company that you're giving away, you receive capital. So that's effectively dilution. If you think about most sort of rounds, typically founders are giving away 15 to 20% of the equity of the company for a funding round. When it comes to debt, there's no issuance of shares. So the debt it's paid back, and it means that the founder is able to keep their level of shareholding and not have to give away their shares to another investor.
Fantastic. And are there any specific prerequisites for that? So as opposed to, I guess, maybe profits, or as opposed to using it for equity and using a non-dilutive route instead, would you say that you have to be at a certain stage or a certain level of business?
So look, profitability is becoming certainly come back in vogue of late. Say 3-4 years ago, it was less relevant when we were in sort of, everyone was looking to get into, everyone was in burn mode. People were, equity was very, very cheap. There was an abundance of capital, and the debt markets sort of operated in a very similar way. Now people are very focused on funding companies that have got attractive unit economics, a strong pathway to profitability, or could be sort of marginally profitable. Revenue is very important too. So typically most lenders will want to see evidence of product market fit, which could very is a proxy. You're sort of talking about revenue. So typically sort of 2 million revenue plus, and then ideally in terms of being able to sort of have as much optionality as possible and the most favorable funding options. If you have a VC on the cap table, or you've been able to raise equity from an institutional investor, that will also help source that debt capital as well.
Okay, fantastic. Thanks a lot. And you often say you help companies raise smarter, not just faster. So what do you mean by that?
So people hire us for a number of reasons, but we like to we've seen it in evidence a number of times. We're able to help founders source better terms, so higher valuations or higher quantums, but also sort of more importantly, finding the right relational fit. So finding sort of the best investor who is able to become a long-term financing partner who will be able to sort of stick by them even if things don't go to plan. That's really important. If you hire us, we are typically going to help you raise faster, but also on better terms, and with someone who we believe that you're sort of more relationally suited to.
Okay, understood. And so if we take a step back and maybe come back to Mountside Venture and the general mission. So you are very much involved in the ecosystem, as we said. You work both with founders and startups, but also with VCs and LPs, so GPs and LPs, which is somewhat unusual. I mean, usually, I guess advisory firms would focus on maybe VCs and others like towards founders. Could you describe a bit more like your role and how you connect all the dots and why also you do this? That would be quite helpful to understand your general role. And also in terms of scale, Mountside Ventures, I mean, what does it represent today, maybe in terms of mandates, maybe in terms of, we spoke about fundraising, so what sort of, tranche or brackets of fundraising do you focus on? That could be quite helpful to understand.
Yeah, so look, key aspect of what we're doing is being able to have that market knowledge and that market insight in almost in real time. So we're predominantly helping founders raise capital, but also we want to provide really high quality opportunities to the VCs, to the GPs, so they can actually deploy that capital, and then helping them to actually sort of fundraise as well. Is for us that means that we're actually able to point our founders in the direction of really high quality managers. So they're sort of accessing the best managers with the best fit, who, sometimes they may not have been able to raise. It's a really tough fundraising market out there. And, from the LP perspective too, there's so many funds that they need to sort of see and speak to on a daily, monthly basis. If we can provide a curated list of these funds and make those introductions, we can make their life better. And for us, it's just being that exception brand of the ecosystem, being able to support all layers of the ecosystem. That's going to help us build trust and credibility, and ultimately serve our founders better.
So you've become a B Corp. And that's obviously a big step for every business, but particularly as an advisory firm, how's that changed your behavior? And are there any quantifiable things that you could point to where you would say these are different processes we've implemented since then?
Yeah, I mean, look, we spent a lot of time going through the process. It was very important for us to become a B Corp. Where I think it's probably made the most change is firstly in terms of maybe screening out some companies that probably didn't align to our values, or we didn't see a sort of a strong relational fit. I think probably where it's had the most impact is where we've actually been speaking, where we speak with founders who are actually B Corps themselves. There's a real sort of meeting of the minds, and it feels like you sort of accelerate that process, and it's almost like going from the first date to a third date, because you've got those very similar characteristics. So we help in terms of actually speaking and working with clients. When we do speak with a new B Corp that we haven't spoken to before, it just makes that whole process so much smoother and better. And I think we're all more incentivized to try and find a way to work together.
Okay. So coming back to maybe like rounds for fundraising in itself. So you're in a situation where you see hundreds of different transactions. You're not in the seat where you essentially necessarily judge the founders straight on would a VC do. A VC, you are pitched, you take a decision within an hour, and then that's it. So you are more like a coach, let's say. What would you say are the most common fundraising pitfalls when you are on the side of the founders? And what sort of recommendation would you give to them? And how often, do you reshape the entire fundraising process when you start working with them? So a few questions within the same question. So first, what are like the main pitfalls you see in a fundraising process? Second, what are the typical recommendations and patterns you see, and how often do you reshape the entire process?
Give you the consultant's answer. It depends. There's lots of times we work with very high quality businesses. Often the clients we work with could raise by themselves, but they choose to work with us because running a startup is a full-time job. So if you work with us, we've got an efficient, scalable platform that's singularly built for fundraising, and fundraising becomes a full-time job. But some of the key things that we often have to change is, particularly with people who are sort of more used to raising on the debt side, if people have just come off an equity round, we need to sort of make a more debt-friendly business plan in case debt investors typically don't like funding into a J curve, or at least don't believe that J curve is going to be real. Typically, what we see is the main interaction we have is having very crisp messaging around, what the problem, where the solution is, why this is a unique business that's worth investing in. And often when founders are trying to do it themselves and, super busy, they could just sort of overshare information. They could just send lots of information without thinking about the best way to frame that particular response. Or, there's documents that sort of might have some errors or contradictions in it. So, look, as I said, we work with high quality founders, and we don't see lots of issues, but often we spend a lot of time on the financial model, on sort of the narrative. And again, I think one of our key USPs is just sort of optimizing that process, knowing what people like to see, knowing where the issues are going to be, and we try and get in front of those beforehand. We're always probably thinking 2 or 3 steps ahead, not just trying to just satisfy one information request in isolation.
Okay, understood. And maybe same question, but on the VC side. So you've mentioned that, raising funds, it's quite hard. Maybe particularly even more so today. On the VC side, when you're an entrepreneur, you feel that they have the money, they are rich, they are floating on a little cloud. But from what you're saying, essentially, it's actually not like this, and it's actually super hard. Maybe can you elaborate a bit more on their own situation and their own trouble when it comes to fundraising?
Absolutely. So look, if you think about the success rate that a founder has and the number of meetings that a founder might need to make to get a term sheet, it is significantly higher for a VC. It is much, much more difficult for a VC to raise, which again, you might think is difficult, particularly for a founder if you're going through the process, or you've just come out of the fundraising process and you're feeling particularly bruised and battered, and it's taking you 6 to 9 months. You're speaking with people, all of these people you're speaking to have money. But for them, it's been very difficult. And I think that was probably quite well evidenced by the number of people that applied for our emerging VC program. We had over 520 funds across Fund 1, Fund 2, Fund 3 apply for 20 places in the program. So I think that, these are all professional investors who have very, very good experience, great track records. But I think just that in itself demonstrates how hard it is to raise capital. You can see it in some of the data in terms of lots of them, a lot of the money that at the moment is going to the very, very large, very established VC funds, and some of the newer, more niche funds are being sort of crowded out. So it's so much harder to be able to get in and sort of convince someone to part with their money, because you're dealing with institutional investors who they are taking a very significant risk on you. Often they are working with, you're having to work with asset allocators who want to be able to deploy very regularly into very large funds. So the incentives are quite there sometimes for the smaller fund managers in particular.
And maybe, so what's your take on the general market in terms of VCs? I mean, you can see on the private equity side of things like already some consolidation. So I mean, you've mentioned like the large super successful VCs like Sequoia, but what do you think what's your thoughts and about for the other ones, like, so let's say the long tail, which is very, very long. So and do you think it's going to be harder for them, like year after year? And are we going to see some sort of consolidation too in the VC space?
I believe so. I think there's a number of funds that, the bulk of their investments in, 2021, 2022, 23 with, very high valuations. There hasn't been, those funds haven't been able to return much capital. The exits haven't really been there. So I think those funds in particular, there are a lot of new funds that sort of started in that sort of vintage era, will struggle. They will struggle to raise another fund. So there's certainly going to be some consolidation. There's going to be a number of sort of those smaller, medium-sized funds that leave the market. Overall, there's been an absence of DPI, of exit, of returns across the industry. And then, that is helping to shape the LP sort of interest or lack thereof in some of these smaller, medium-sized funds. So look, it's tough out there to raise, but conversely, we're also seeing some really sort of green shoots. So the last quarter in particular, there was over 9 billion of VC funding raised in the UK, which I think was the second highest on record. So we're starting to see some positive momentum again. And look, a lot of those are skewed to very large rounds. Revolut, for example, was one of them. It's going to be difficult for a smaller, medium-sized fund to raise over the coming years. But I think that's sort of part of the natural evolution. There are managers who have been less successful, they won't be able to raise, and then new crops of managers will come up. And I think the important thing is making sure that they get their chance, their opportunity to raise and to deploy.
So fast forward, I don't know, 20 years, do you think there would still be small VCs focusing on pre-seed, early stage, or would they all be integrated in much larger investment platform, you think?
I think there's still very much going to be a space for sort of pre-seed, seed. And I certainly hope so, given some of the talent and the ideas that are coming out of the UK and Europe. I think actually the UK and Europe's very well supported by those types of funds. I think where we struggle is sort of at later stage investment opportunities. But I think there's always going to be a market for that. There's always going to be people that are willing to take that risk and fund these smart ideas, and we need that to happen. So I'm probably quite optimistic about that part of the market. I think where I think there's absolutely going to be consolidation. I think where you can see a change in business models at the moment is with some of these larger VC funds, which are starting to look a lot more like private equity funds. They might have a VC label attached to them, but if you just looked at the management fee income that comes out of those funds and actually what they would need to deploy and the returns they would need to make, and the number of unicorns that need to be in each one of those portfolios to make the returns, to make the math work, I think that's going to be very challenging.
Yeah, I mean, what I meant was I wasn't saying that the early stage would disappear, but maybe they would be integrated in those larger platforms, because I guess it represents much more risk for an LP to essentially drop some money into like a super high risk types of investments. But if it was within a larger institutions, and if they have the ability to diversify essentially their strategies, and they have a bit in early stage, a bit in growth, and maybe some in private equity, they would be more willing to take a risk if the investment platform is able to say, look, on the early stage side, we don't take management fees, and maybe carried interest would be slightly lower. So it was more. I mean, the question I had was more like, do you think it would be integrated or it would still be independent?
I think still be independent, and I think it's that focus on independence is actually going to become stronger. I think there's going to be people that really need to be able to prove that they have a very niche sort of investment thesis and very niche sort of sourcing model, and that sort of era of generalists is going to be less relevant, because if you want that level of exposure, if you want sort of early stage, mid stage, and then very late stage, you can just buy into those specialist funds. So I think it makes sense actually for people to be looking at real expertise that the investor has, and do they have really strong identifiable sourcing? What are you paying for in terms of that management fee? Are you just paying for a generic investor, or are you paying for someone who's got a really, really strong angle, a very, very niche investment thesis, who is likely to deliver much higher returns?
Okay, makes sense.
You've been engaging with HM Treasury as well on innovation funding. If one change unlock capital, what order of magnitude are we talking? Like, is it billions per year or percentage of pension assets under management redirected?
What we're trying to do is, as part of the broader Growth Credit Association, and I suppose this very much aligns to the government strategy around sort of supporting UK growth. Right now, there's a real absence of UK LP or UK investment into UK SMEs. Most of the growth and venture debt funds are supported by European and North American LPs. There's very limited. If you think about, you take a step back, we're effectively reliant on foreign capital to support UK SMEs. So what we're trying to do is find ways to encourage UK investors to support UK SMEs. And one of the ways we're doing that is sort of engaging with Treasury, with the Bank of England, with the British Business Bank. We're looking at different structures potentially to make more practical, because people are always going to be very cautious around cost and pricing. I think the UK in particular is sort of known to be a very conservative jurisdiction around, both from individual mum and dad investors who have a very high prevalence to invest in cash, but also institutional LPs who are investing into gilts and other sort of cash and bond funds, which have very, very low fees, but also conversely very, very low returns. So we're trying to, I don't think we've got a specific number in mind yet, but we're really trying to, it needs to be meaningful. We talked about, we want to see on the growth debt side, hundreds of millions more sort of put into the system, and having UK LPs benefit from the growth of UK SMEs. And I think as part of what is also sort of more broadly happening with the Mansion House Accords in terms of getting more investment into private equity and venture capital too. And, people have sort of made commitments to get, 1% to 2% more in there. That's going to have a material change on the market, on the availability of private capital, which I think, to your earlier point, is going to, over time, not immediately, make it easier to go and raise these, early stage funds and even, later stage funds to support UK and European startups, because the LPs now have a requirement or a commitment that they need to find somewhere to put that money.
Great, thanks.
I mean, on this, maybe some sort of parallel with what's happening in Europe, like the scale-up fund, which is being set up by the EU. So you said that, I mean, if in the UK, if the Treasury was pushing pension funds to put more money at work in the innovation space, it would go in the hands of UK-based investors. But when I looked, or maybe I'm mistaken, but the scale-up funds, I think like essentially the managers who essentially showed up to the EU, but were EU-based investors, but essentially international investors, like maybe like an EQT, etc. I mean, they remain European, but they are like enormous investment platforms. So, or maybe Also, it's not settled, etc. yet, but it seems that it will essentially the billions will end up in the hands of already ultra large asset managers and not really in the small ones.
Absolutely. So look, that's something that we're trying to actively get ahead of, and I think our engagement's been very focused on the smaller, more UK sort of domiciled funds and making sure that investment goes to those funds, and the mandates of those funds is to support UK SMEs. Completely agree. Look, lots of times when you get people saying, we're going to allocate, X% into alternative assets. What that means in practicality is that people go, okay, I'm going to invest in KKR European Buyout Fund #1 or KKR Global Buyout Fund. And, it's obviously an American firm, and, lots of the investments are made outside of the UK and Europe. So that's always a default. And I think that's one of the issues that you're always going to be grasping with is, there are certain sort of intermediaries across the value chain. People need to know that if they're going to invest the time and energy to sort of understand a new asset class, that it's worthwhile for them, that there's going to be a constant avenues of deployment. And for the larger funds, it's much easier to attract capital because there's always just a ready supply of investment needs. So look, I think it's always something we've got to be conscious of. And I think we've probably been a bit lucky that we're starting this sort of initiative and this planning now with the benefit of seeing how this has worked and what hasn't worked as well in different jurisdictions.
Hopefully,
Makes sense.
the money will stay within British hands and local players. Maybe if we go back to founders and startups, we hear a lot about equity fundraising. I can't even remember the last time I read about debt fundraising. In your opinion, at what point or what sort of business do I need to have as a founder to be able to think about debt as a financing source for the business versus equity, obviously?
Absolutely. Look, what I say to sort of most founders, and I think this is a pretty good yardstick, is, are you more worried about dilution or keeping the lights on? If you're more worried about, well, I've got bills to pay, payroll, I've got some big working capital movements coming up in the next 6 months' time. I still haven't got my burn rate under control. Then debt probably isn't the right answer for you. If you are sitting there going, hold on, I need some capital to grow. Everything's working really well, but I don't want to give away 15 to 20% each time I grow, each time I fundraise. Then debt is probably a good choice. Of your overall metrics, it depends also what you're buying it for. If you're just looking, if you're bridging to another round, or it's a bridge to profitability and sort of a typical sort of feature and growth debt loan, then you're looking at typically most lenders will want to see sort of 3 million revenue plus. But if you're purchasing assets, for example, if you're a fintech, or if you sort of you're an asset leaser or something like that, then actually you could have a much lower amount of revenue, but because there's security available to the lenders, then they'd be more comfortable providing you with that funding. So typically, you want to have improving unit economics. You want to be very confident that if you take more money here, it's think of it a little bit like a sausage factory. If I can put $1 in here, I'm going to get $5 out. Then debt is a good use of capital, a very efficient use of capital for you.
Yeah, that's really interesting. And just digging into that a little bit more. So venture debt and growth debt, it can sometimes be a little bit muddled. So where do they meaningfully differ? And what share of your recent deals would you say used warrants or PIK versus covenant, like cash interest loans, for example?
Yeah, I mean, look, in terms of venture growth debt, the terms get used pretty interchangeably. I think 3 or 4 years ago, venture debt was sort of the it word because venture capital was so cool and people were so aware of venture capital. Now, I think I see a lot of funds who are more inclined to sort of refer to themselves as sort of growth debt providers. And look, that's actually typically the use case for venture or growth debt is growth. So if you're lending to a loss-making company, you're wanting to see the funds being utilized for growth. So yeah, they're fairly interchangeably, but I'd say that there's probably a bit more of a movement towards growth debt, and it sometimes sounds less risky. So I think that's probably where you'll see more. In terms of terms, look, I think there's more and more entrants coming into the market all the time. There's such a growing awareness of the asset class. I think that some of the difficulties in being able to access venture capital funding has meant that, a lot of venture and growth debt funds have sort of stepped up. And as a result of that, there's a very, very broad array of structures available. So, right now you can source, 3, 4 year, 5 year bullet facilities, similar to sort of a unitranche facility. Typically those types of facilities are only available in sort of the mid and large cap debt markets. Those are sort of coming in now. So there's some providers doing that. Number of providers looking at, cover-lite or no covenant loans. We've had one at the moment where it was a subordinated, no financial covenant transaction with no equity kicker as well. And I think the funds have become much more pragmatic around sort of, equity kickers and warrants, for example. So some realize that, if you're about to raise an equity round in the next 6 to 12 months, having a warrant that's sort of been put on the cap table that references the last valuation might be sort of a line in the sand that's unhelpful. So they might be looking at a percentage of proceeds or just a nominal, like a fixed exit fee. If you look at sort of the US market, which is probably about 5 years ahead of the UK, there's, most facilities, I'd say 50% of that market is sort of, a warrantless market. It's just high yield, senior secured debt. And the rest are, effectively sort of cover-lite loans with an equity component. The funds are being a lot more commercial these days with the warrants and the requirements. It's not just here you go, here's a 4-year loan with a 12-month capital repayment holiday, 2 covenants, no matter what the business is. There's a little bit more structuring, and I suppose probably more borrower friendly terms that are coming into the market. So it's a good time to be to be a borrower.
Less personal guarantees, things like that can always be very stressful.
Exactly. And look, we don't work with funds that sort of require personal guarantees. I think, a founder has enough on the line already with the business and what they're doing. And typically the business is at a level of maturity that, that's just not an appropriate level of security.
Yeah. And you just mentioned quite a few different structures. So how do you choose between those structures or help the founders decide what's right for them? Yeah.
And again, consultants answer, it depends. The key things we look at are, the cash flow burden on the business. So, interest rate and cost is one thing in terms of your fees and margin. But if you have a bullet loan where you're not having to make repayments for 4 years, you might have a higher interest rate, but the total amount of cash that goes out of the business over the next 4 years is, significantly lower than an amortizing loan. So actually, if there's still meant to be sort of material investment over the next 12 to 18 months, or, you've got it, you're unsure around some, large contracts hitting, then, being able to sort of keep the cash in the business can be absolutely crucial. That might be the most important aspect. For other companies who, they might have a strong cash buffer already, they might have already raised debt previously, they're very used to sort of managing debt, but, the business is absolutely flying. Then in that sense, and it's like they'll raise equity in the next 12 to 18 months, then it makes sense for us to sort of more heavily negotiate the warrants or look at structures without warrants, because that's actually the most likely scenario is that they're going to raise in 12 to 18 months and they're going to raise at a much higher valuation, and therefore the warrant's going to be more valuable and cost the company more. So it really depends on the unique situation of the business. Typically, it's the key commercial terms, it's the cash flow implications, it's the valuation aspect, and again, coming back to sort of relational fit, it is what is the likelihood of something not going to plan? How supportive has this lender, has this fund been on similar transactions? How well do they really understand the business, such that in 12 months' time, if things haven't gone to plan, there's been a breach of confidence, and that lender, that investment director needs to sit in front of their IC or their credit committee. If they really have a strong understanding of the business and the key drivers, they can better represent you and the company's interests, and most likely are able to get a more favourable result for you. So, that sort of track record, how they've supported their portfolio and sort of their sector expertise, that also becomes quite relevant too.
Yeah, makes sense. And you were mentioning briefly personal guarantees before. So, when things do get messy, missed plans or covenant pressures, or even maybe a default risk, how do you assess whether a lender will be a true partner, and what forms of, I guess, portfolio support or behavior have you seen that genuinely can change those outcomes?
Yeah, so look, as I said, we don't work with any funds that require personal guarantees. We only work with funds that have established professional, investment thesis, that they've been in the market, they have a reputation around, supporting their portfolios, and it creates an issue not just for the fund, but for the sort of the broader market itself, around people who would be too quick to sort of enforce, or be very difficult if there's sort of an event of default. So we typically see, it's sort of been our experience, that the funds have been, and my experience personally, the funds have been very, very supportive of companies that have struggled, they might have lost some major contracts, something's gone wrong, there's been some sort of adverse regulatory change that no one saw coming. And in some cases, people have sort of lost 30, 40, 50% of revenue overnight. Most of the time, the lenders, firstly, they just want to see, accurate, transparent communication. Don't try and hide issues from them. If you act that way, they're always going to want to try and find a solution. And often I've seen lenders actually, first point of call is typically, okay, so what went wrong? What are you doing to fix it? What actions are you taking? Let's go through a bit of a reforecast exercise and understand what the longer term impact is. Many funds have actually provided more capital because they've seen, okay, you've had an issue here. We know that we're taking a risk, but we know that actually you just need a bit more capital to get through this. And actually you might have an opportunity to consolidate and acquire one of your competitors and end up in an even better situation. Often if things go really badly, companies are sort of having to cut costs, or they're raising additional equity. So that's why a lot of funds like to work with VC-backed companies, because it's not just the lender that has access to capital, that there's someone else on the cap table that could provide funding if required. So I think you probably just need to look at also the portfolio performance of the return performance of the major venture growth tech funds across UK and Europe. Most of them are sort of mid-teen IRRs. They haven't had a lot of, there haven't been too many, deals that have gone south. And they've really supported their portfolio. And there's a couple of funds that I work with that, I know their teams and their portfolios very well. And now actually it's sort of part of their origination, and it helps them sort of, differentiate itself compared to other funds, because they've got a track record of supporting their companies when things haven't gone to plan. And that means a lot to founders, and that builds a lot of loyalty, and overall it's helpful to the exit class.
Okay. And so how keen, so we understood a sort of situation, from a founder's perspective and from the company's perspective. In your views, and so what you see, how keen are the VCs backing those companies with raising debt? Because, I guess if the business is doing great, as an equity investor, I'll be okay. I want to put more money at work, not too keen on the debt, because if things are, going a bit, not necessarily completely south, but if it's becoming a bit more difficult, maybe, at the time of exit, I'm not going to be the first one being served. So how keen are they, in practice?
It's a great question. Look, absolutely. When a company's doing well, VCs have pockets of funding for follow-on capital and reserves that they typically want to double down on the high-performing businesses. So in some instances, we're certainly in competition with the existing investors. They're one voice on the cap table. Often it's the founder who sort of has the founder and the other investors who have a sort of a casting vote sometimes, or a lot of a lot of investors don't want to sort of overrule a founder and the founder's dreams and ambitions. And look, I think most VCs, particularly now, see debt as a useful tool to help sort of aid companies to grow, to sort of grow faster. Often it's, yes, actually the VCs have been supportive. And they might have invested, say an extra sort of 5 million, but we'll come and supercharge that and put some additional debt on top. So yes, it's not a zero sum game, because we can also work with that equity and new equity investment. And look, there are times when we come in when a fund might be sort of nearing the end of their deployment period, and we're a very welcome addition, because they'd be able to support them, but not with as much capital as the company needs. Typically, we find the VCs to be pretty supportive of raising debt.
So, so regarding your involvement now, I mean, you do a lot of things. So equity, debt, involvement with the treasury. You're also working with the Growth Credit Association, so in the UK. Do you think you could tell us a bit more about what it is, what they do, like the purpose, and maybe like a few suggestions you'd have, like for the general market, to have a bit less friction and be more optimized in some way?
Yeah, so the Growth Credit Association was really set up to sort of help support a lot of the discussions and the engagement that we're having with the Bank of England, with Treasury, with the British Business Bank at the moment around sort of mobilising capital, but also just to sort of be a unified voice around key issues that matter. And it was probably quite surprising that it didn't exist already. So it's very much in its infancy, and to build on that, I think. Look, the market overall and the funds that we work with, it's a very collegial market, but it's not a market where the likes of VCs have WhatsApp chat groups, and it's a really incestuous world. Everyone knows everyone. There's lots of co-investment. It is the same in the debt world, and in particular in terms of the venture and growth tech space, because most people are operating on a bilateral basis in competition with each other. They're making one investment, and there isn't a need to sort of co-invest. There's no sort of syndicated facilities. We're seeing probably there might be one or two sort of syndicated or sort of club style venture debt facilities that close later this year, but it's therefore not a market where there's sort of that natural sort of communication and collaboration that occurs either in VC or in the larger sort of debt world, where everyone's on syndicates together and you've got to work with 10 banks on the same deal. So a lot of it is just around sort of sharing ideas. Everyone is bound to confidentiality, and it's a different world. Most people are signing NDAs when you're providing debt, so that's very different to the equity world. So we have to be careful around what we're talking about, but it's more sort of we're all working with the same people, having the same issues. So it's just it's more a helpful forum and getting people to sort of understand the issues that we might be seeing in different sort of sectors, and early warning signs that if someone sort of has a learning from a deal or something that's gone wrong, that sort of information can, there's just a bit more sort of knowledge sharing, which is nice. And I think more useful to the market, but overall it's a very collaborative market. I wouldn't say there's anything that really needs to be done. I mean, I'm probably always going to say people need to, we want to sort of close deals faster, but when deals need to be closed, things need to be done. My experience has been that the funds have been very supportive of that, and they'll work to the timelines that are needed. So actually, it's a great market to be working in.
And just talking about the market.
Yeah, I was going to say, so talking about the market is, you mentioned that it's not so bad, and the sentiment today in the market is that it's very hard to raise money, etc. But from what you see, it's not going so badly. Do you think you could elaborate, maybe giving a bit of numbers, volumes, etc.?
Yeah, I mean, look, we had our busiest Q1 ever. So we provided over 50 million of funding in Q1. That's sort of two Series A, two Series B, and a debt deal. We certainly, in terms of just the broader debt market, there are a number of the debt markets, in particular venture and growth debt funds here in the UK, it's becoming a much more mature asset class, rich investment thesis. The underwriting criteria hasn't really changed over time. As I said, the loss rates are very sort of stable, very, very low, in fact. And there's a lot of dry powder. So they've raised lots of funding. There's been lots of funds that have closed over the past 12 to 18 months. You know, at Tempo and Claret have had some very recent, very large fund closures. There's lots of money out there ready to be deployed. And I suppose, unlike the VC market, we don't see these swings in terms of underwriting criteria and really hot sectors. It's much more sort of stable and consistent. So on the debt side, I see that continuing for the next sort of 2 to 3 years, and I think it's going to probably only improve. On the equity side, we've had a phenomenally busy shift last month. I think we've signed up four new clients in the past month. So look, we've got one of the busiest pipelines we've had in a long time, with some very, very high quality businesses in them. And I think that we're coming into a very, very busy time for the next 12 months. I think lots of people have sort of taken their medicine. They've sort of had to sort of cut costs and had to sort of accelerated path to profitability. We're seeing AI provide a lot of productivity gains for clients. There's sort of the AI native businesses that have got, say, they're very much the outlier, sort of hyper growth, and are able to access lots of funding. But, just more broadly, we're seeing companies who ordinarily might have been, required to have 4 devs. They're doing the same job with 1 dev at the moment, or, they've kept the 4 devs, but they don't need to hire any more to grow, because they're utilizing these AI tools, and their way of working has changed. So they're becoming more efficient, and that's starting to get the growth rates back up again, and that's getting people interested in funding.
Interesting. How should founders benchmark their cost of capital in practice? So against venture debt and broader just private credit or unitranche markets? And how do they quantify the trade-offs between debt and equity? So in terms of dilution, for example, at exit, or just overall cost?
Absolutely. So one of from just sort of comparing debt to equity, the biggest thing is that we look at is what percentage of equity are you giving away? What is the cost of that equity on exit? So if you were to if you dilute them by 15% at the Series B round, if you were to exit for 200 million, 15% of 200 million is 30 million that is no longer going to shareholders. So that's a very quick way to go, okay, should I raise some debt instead of equity, and I can keep my shareholding at this level? Because if I do, that's how much additional sort of equity value is available to me. When you're comparing sort of like for like, so the offers that come in on the debt side, I mean, if you're a venture or growth debt, if you're sourcing venture or growth debt, that's always going to be more expensive than your mortgage, or the debt that's provided to a established corporate that's been generating sustainable EBITDA cash flow for 3, 5, 10 years. But there's a known market in terms of what the typical sort of pricing is. So you can always cross-reference against what other funds are providing for that same credit risk, and that's obviously a big part of what we do. We've got we know pretty quickly where the fund should be priced against a particular transaction. I suppose how do you try and optimize for that? We're always trying to optimize. We're trying to create as much leverage as possible in a process, get as many offers on the table, and that's where we're able to, on the equity side, to drive valuations up, or maybe look at sort of a secondary transaction that comes in alongside the primary. Or on the debt side, it's around being able to negotiate sort of improved pricing, extend the capital repayment holiday. I typically, a lot of people try and sort of compare, a mortgage versus the beach debt pricing. That's not appropriate. The other aspect is, can you can you handle the interest of the servicing costs over time? So, debt's an obligation on the company to sort of repay over time. It's cash flows from the company. If you're raising equity, that is an absolute known dilution amount that is hitting all shareholders on day one. So that's typically how we would look at it, and we try and make it as simple as possible in terms of comparisons around different providers and different valuations.
So what's sure is that the market has shifted a lot towards profitability, so it might not have been the case a few years back. And so how do you see this in numbers, like really? Like, so if you are a business, you don't have like a strong path to profitability, essentially debt will be dead for you. I guess even equity is hard now, but how profitability has evolved, like essentially in financiers' mind.
3 years ago, it was a nice to have, and always people would sort of question your sanity if you were looking to be profitable in the next 2 to 3 years. It's like, why aren't you just burning, grow the top line? Now, it's completely flipped, and typically what we need to be able to demonstrate is that there's a path to profitability within 12 to 18 months. The sooner rather the better on the debt side. And again, it depends on the scale of the business, and people, if you've got a more mature business, you've got sort of profitability or you're marginally profitable, but you want to go back into burn mode, that's fine. People, lenders are okay with that, but they want to see that there's a pathway out of burn mode, and that you've got strong unit economics to support that. Yes, profitability's become much more important. And look, it's in that sense, it's good discipline for having debt anyway.
Makes sense. I was so moving on into slightly different topics. So just with the AI boom at the moment, and I think I was at an event the other day with a venture founder, and a founder of a venture studio. He mentioned that something like 60% of the funding is going into AI at the moment, or something like that. So with this in mind, stepping back and looking at the AI craze that's happening at the moment, some suggesting it could be a bubble, could not be a bubble. How are AI companies actually faring across equity and debt? So in your opinion?
Look, I don't have anything probably contrarian to say to that. What we're seeing for sort of the pure play AI native businesses, they are growing at rates that we haven't seen before. They're they're very successful, and they are attracting lots of capital. So I would absolutely agree with that. I think there's been an element of AI washing at the moment. So a lot of companies will tell you that they're an AI business and they incorporate AI into everything they do. That might just mean that they've got their own sort of GPT wrapper, or they've got a database that's got some sort of enhanced functionality. People get pretty good at being able to sort of pick that apart these days. So investors have got smarter, and they're better at sort of figuring out who actually has some tangible IP or technology that's they're doing something different. And look, I'm absolutely seeing companies becoming more efficient and growing faster via the use of AI, whether or not they're sort of deploying someone else's tools or they've developed their own. So it's something that's those companies are attracting capital, and rightly so. I mean, look, some of the valuations are sky high, and that's always going to be problematic. But on the debt side, it means that a lot of companies have just be very capital efficient, and as a result, they've become quite attractive for debt funding as well.
And what would you say is the share of AI that you've seen in your fund at the moment in comparison to the other industries?
In terms of the transactions that we're looking at, I'd say that it's probably about 30% is sort of pure play AI.
So that's quite a lot. And so we mentioned like the frenzy around equity investment within AI companies. Is it a bit the same with lenders? Are they getting a bit crazier when they see, an AI company, or are they, in essence and by nature very disciplined, because for them AI or non-AI it's the same? We are looking at, if the company can repay the debt, period. We are not necessarily looking for the sky high returns because we are debt providers anyway. So, I mean, do you see like they are still being very disciplined, or maybe some, like wants to chip in because they want to be in the next AI startup?
Absolutely. Look, you're spot on. Debt investors are fixed return investors. They're more focused on getting their capital back, albeit, in the venture and growth debt space, many of them have some form of sort of equity kicker and, exposure to upside, albeit it's very minimal. I would say, and I'm seeing this probably across debt and equity, people are becoming more cautious around defensibility. So, look, if you've got the metrics where you're growing strongly, you've been able to attract some good VCs on the cap table, that's always going to be really interesting for debt investors, and you're probably going to be very successful on a debt raise. But people are very cautious around the fact that if you've been able to grow so quickly and do this, what's to stop someone else doing? Particularly in 6 months' time, when there's going to be better technology and people have been able to learn from what you've done. So defensibility and that kind of moat that people have around a business has become more important. There's lots of people talk about the era of B2B SaaS being over. I think maybe there's some truth to that in terms of some of the smaller subscale businesses, particularly ones that had a very sort of niche product selling into SMEs where the code base can be easily sort of replaced. But there's a lot to be said for distribution. There's a lot to be said for high quality, clean code where if you're in sort of mission critical infrastructure and you're selling it to government or MNCs, people don't want to be working with a small, scrappy startup that they might have built that no one can really accurately see where the codes come from. So defensibility is probably a really big focus for both debt and equity investors now to make sure that, yes, you've done a great job getting to this point, but how easy is it for someone else to do that too? So it's not a slam in terms of being able to access funding.
Okay, so I mean, I imagine also as a lender, if I see like very strong VCs backing the company, I feel a bit safer thinking, okay, if the company has a bit of a down, I mean, the equity provider will essentially want to save the boat, and I may get repayments like this, or is it something that would happen in your opinion? Or?
Yeah, look, that's part of one of the main reasons why debt venture and growth tech providers like to fund VC-backed companies because, firstly, there's someone else on the cap table who's got access to capital. But secondly, it's because, someone else has had to go through due diligence. Someone else has put them through 6 to 9 months of diligence. And as a result, there's probably enhanced corporate governance because now if there wasn't a sort of a formal board structure in place, there's now a board structure in place, there's enhanced reporting, and they've had access to capital to sort of grow and accelerate, and there's likely sort of enhanced liquidity in that business. So yeah, absolutely.
And after the Builder AI episode, so how have covenants and advance rates required runway buffers changed for AI companies? So maximum months of liquidity or coverage ratios, for example, has that changed?
It hasn't really changed a lot. I think it's one of those things where it's always a risk. Fraud is very hard to protect or structure around. If someone is willing to sort of defraud you and sort of misrepresent sales, and they're able to convince multiple people in the organization to do so, and it's successful, there's not a lot you can do about that. That was a company that was audited as well, so arguably a lot of this should have come up in diligence in the audit. It was a complex situation. It was a multi-jurisdictional company. But I think that's where part of it was flagged, and some of it was flagged in the reporting in terms of, old school bankers tracing cash flow and not being able to sort of get from the P&L to the closing cash on the balance sheet. So I wouldn't say it's changed the structures or advance rates or anything like that, but it's made people more aware of potential fraud issues and some of the hype around these companies, and making sure actually these customers are real, and there's probably a bit more of a deep dive on revenue recognition and actually sort of doing that the work around tracing cash across various jurisdictions. So their name changes, it's likely it's just pushed out time to do a deal because people are doing more analysis and people are more skeptical.
And so a quick question, like on the due diligence phase, actually. So, I mean, you saw a lot of deals. You help founders through the due diligence phase. How heavy is it on the technical side? Because, I mean, if I had to run a due diligence phase, for me, like technical would be very strange because I don't have the technical background. So I wouldn't understand anything about AI really. So a company could come to me and say, I'm AI. I'll be like, okay, sure. But how heavy it is like on the technical side of things today? When you see funds, I mean, do they really spend a lot of time digging into the tech just to make sure that the model is proprietary, or if it's not like a bundle of a chat GPT? And do they really go deep into the technical aspect? I don't know if you've seen a few.
Yeah, and look, in the later stage transactions, often VCs are looking at getting your commercial due diligence done, technical product due diligence done. One of the ways you can very easily verify, the quality of the IP or the technology is whether or not there's actually been patents granted. Has someone else sort of recognized the value of those patents? So yeah, in some cases, yes, particularly for the bigger ticket deals. And on the equity side, people are always going to spend a bit more time on the product, on the technology. For a smaller ticket deal, working with a generalist fund, they're never going to have that in-depth sort of technical product expertise. But as I said, I think we've had enough time now that people are being sort of AI washed enough times to sort of be able to spot pretty quickly whether or not this is real. Yeah, so look, for the bigger rounds, absolutely, and people sort of rely on external advisors, or if you're working with a more specialist team, there's a lot of very technical product heavy VCs that have that knowledge. For the ones that don't, they're typically relying on external reports or sort of external validation, and that's very similar to the debt piece as well, where most lenders are they're probably naturally skeptical. And again, they're not looking for that same upside that equity are. So it's a little bit less relevant for them.
Okay, understood. So, but before we had that chat with you, I mean, we essentially stalked your LinkedIn, and you recently wrote a you recently wrote a piece on AR lending. So I was wondering if you could essentially give us, I mean, the definition of what it is, how and why it emerged, and also today, what sort of part of the lending space it represents. That would be quite helpful.
Glad it wasn't something naughty. The main reason I sort of wrote that is, I think in the space of a couple of weeks, I had three different investors who were, sort of large cap, mid cap investors, some at banks, some at sort of very large credit funds, who were bringing me up to say, "Hey, look, what is this ARR lending thing? We're in a pretty tight process at the moment. We're struggling to get the same amount of leverage into these companies, and we've heard through the advisor on the deal or through the video of the company themselves, looking at an ARR lending facility. What am I missing? What's the magic here? How can I sort of unlock this additional funding?" And I think probably my key point is that really there isn't a huge amount of sort of special sauce, and it's really just a bit of arbitrage, and it's sort of classic private equity trying to maximize leverage into a company, to make an acquisition work. Where sort of ARR lending started from was in the earlier stage market, where you couldn't underwrite on the basis of EBITDA because the company wasn't profitable. So the typical sort of debt to EBITDA metrics weren't available because the companies were loss making. So all of a sudden people went, okay, I'm going to lend you a percentage of ARR. And I'm going to cross check that against the level of equity that's been raised. And that was how people were lending to early stage businesses that were loss making, because they were lending a percentage of revenue, not a multiple of EBITDA. And look, it can be sort of relevant for companies who, are very sort of high growth, and that revenue is really going to rocket, and it doesn't make sense because they might become, they might go into loss making mode again. So sort of measuring a structuring facility on EBITDA when today they might be profitable, tomorrow they won't. is it going to work? So that sort of necessitates ARR. I think where you're starting to see people sort of stretch leverage is in these very large deals where, look, arguably there's lots of sponsor equity coming in. So there's fresh, new cash equity that's coming in to the deal. And often they're sort of structured as PIK type transactions, so not cash pay interest. And they're serving as a bit of a bridge for 2 to 3 years before there's either going to be significant sort of bolt-on activity or they're going to exit to the markets, and they're still going to exit based on a revenue multiple. So if the public market's going to value in this business on a revenue multiple, then there's potentially an argument to say, well, why not have the debt measured on that multiple too? And if there's going to be significant headroom that this business is going to sell for 14 times revenue, having a 3 or 4 times even ARR facility all of a sudden looks quite conservative if you just sort of comparing revenue multiples on a like-for-like basis.
Yeah, very interesting. And so sponsors are using AR structures to kind of push leverage. Where do you see the leverage stack landing in practice?
I think people are doing it to get sort of 1 to 2 turns above the typical sort of uni tranche. So if you and again it depends on the business or the quality of earnings. But let's just say if a uni tranche is capping out 6 times, for example, typically a sponsor's trying to do it to get to a 7 or an 8 times. A 1 to 1.5 times sort of improvement in leverage multiples can make a big difference when you're talking about a $100 or $200 million business.
And what is the line would you say, between supportive AR finance and when does it get into leverage theater? So what 3 quantitative tests have you got, and what do you think a board should run?
Look, for me, it always comes down to cash flow. I'm an old school banker at heart. That's where I did most of my training. So I'm going to look at the worst case scenario. What happens if this pipeline doesn't convert the way you do? You don't get that margin improvement you're expecting, and what does that have? What impact does it have on cash flows, and are you able to service this debt in a downside scenario? So having a very we all want to be optimistic. We're all, the sources, the use of funds is typically for growth. So everyone's very positive at the outset, but making sure that you've run your sensitivities, that, you can see that if things don't go to plan, that this is not a weight that's sort of hanging over us, and we can actually sort of sustain this debt. And it doesn't mean that we have to completely change the way we operate because I no longer got cash to invest in growth. All I'm doing is thinking about servicing debt. So for me, it's making sure that you've sort of run those sensitivities, that you've got good metrics, that you've got good reporting in place, that that issues are always going to come up. There's always things that aren't going to go to plan, but how quickly can you recognize those and recognize the root issue of those? Debt can sometimes be a useful tool because often people they're not used to the level of sort of management reporting that has to be in place, and sort of the discipline that brings. So it should be very useful for managing, for teams and for boards to have confidence that it's not only them that's sort of having to put frameworks around management, that actually someone else is doing that too. So that's probably my main piece of advice, is sort of running those scenarios, what could go wrong, and also making sure that it is the right partner. Have we done our reference checking? We say this with everyone across both debt and equity. It's not diligence isn't a one-way street. Yes, you want to get the capital from the investor, but you should be diligencing them too. How have they been? How do they act towards their portfolio? If they've said that they follow on, had you been able to verify that they do actually sort of follow on? Have you spoken to founders, to CEOs who have worked with them? Do they add the value that they say that they will? So, a lot of times people are sort of so desperate to raise capital that they're just focused on getting that capital. They don't actually diligence the people who are giving it to them. And I think there sort of becomes a point where that flips and should flip in a deal where actually I've got multiple offers on the table now, that power dynamic changes, and you want to make sure that you're joining a long-term partnership with this fund, with this investor. You want to make sure that you're aligned and that they do what they say they do. Otherwise, it can be painful.
Okay. And so maybe to essentially sort of close down our discussion, if you take your crystal ball, I mean, what do you expect in the 24 months for the, venture space? And in terms of, equity, debt, what sort of proportion do you see, that evolving, and maybe, debt becoming a bit more popular, maybe? I don't know. So what are your predictions for the next 24 months?
Yeah, I think we'll have our best year yet on the debt side here, and I think next year is going to be even better, even bigger. I think just by looking at the pipeline of opportunities that we've got, the quality of opportunities that we're looking at, and again, I think just the momentum around the asset class, the awareness of sort of non-dilutive capital is only going to increase. From interest rates are always important. The broader macro backdrop's also very important. Obviously, we've got a budget coming up in a couple of weeks' time. I'd probably say that we're potentially going to see a drop in interest rates, and that's always going to be more favourable if you're looking to borrow debt. So I see some positive tailwinds on the debt side, and then in terms of equity, again, looking at our portfolio. Looking at our pipeline, it's very busy, and we've got some really high quality opportunities in there. I don't see any sort of change in terms of sectors or anything like that. I think it's going to be broadly the same, albeit I'd probably say my one prediction is that there's going to be the VCs are going to start to look at sort of hardware businesses a little bit more carefully than what they have previously, particularly in the sort of world of AI, actually having a piece of hardware, having something that's sort of differentiated is going to become more interesting and more defensible. So I probably expect to see more, hardware, like hybrid hardware software transactions being completed next year, and less of a focus on sort of B2B SaaS. I mean, I think the world is realizing that you can't run on B2B SaaS. There's more to life than B2B SaaS. So look, I see that as a positive because there's going to be more opportunity there, and I think people are going to be more willing to look at a broader array of investments. So I think next year is going to be a great year.
Okay, so to summarize, quite confident with more, let's say, disciplined investors, but you're quite confident in the future. Super. Listen, thank you very much, Hayden. It was a pleasure to have you on Aulium today. So thank you again. It was great, I mean, to learn more about Mountside Ventures. I mean, the way you see things evolving, etc. Markus, it was a pleasure too. And I hope to see you again very, very soon.
Absolutely. Thanks for having me here. Really enjoyed that. Cheers. Bye.
Cheers.